My name is Gabe Zubizarreta. I'm one of the founding principals of Silicon Valley Accountants. It's my great pleasure to introduce to you today Sonia Luna. She's president and CEO of Aviva Spectrum Consulting. Sonia has over 15 years of internal and external audit experience. She's an elected board member of the IIA Los Angeles chapter. She's been a Big Four audit manager, and for the last many years she's been helping companies with compliance issues, internal controls, and that stuff. So Sonia, welcome. How are you today?
Wonderful. It's always a great day in sunny Los Angeles, California.
Well, actually, I'm happy to say that I'm here in Cleveland today visiting some clients, and I'm going to be speaking at the Mionsky Conference tomorrow at Kent State. And it's actually sunny and very nice here, too. So I can't always say that when I'm visiting Cleveland. But today I'm very happy to say that, that we're very sunny and things are going well here, too. So I know that we have a lot to speak of. I know we've spent some time preparing and discussing this, and this is actually a very big topic. So I want to go ahead and get started. We have the financial challenges and opportunities with the new COSO framework. And so I wanted to go ahead and get started and move along. And again, I also wanted to introduce our webinar here. So our webinar today, everybody knows that there's a new COSO standard out, and Sonia is going to go over, and there's been plenty of webinars on what the COSO standard is and et cetera. We'll contain some of that. But we also wanted to look at this, and when there's a change, there's always an opportunity. And there happened to have been more than one change. The COSO standard has been updated, and we're going to go over that. But there's also been the PCAOB has had some pretty interesting things to say about how we document, how we test internal controls, a bunch of other stuff. So one of the things that we wanted to do with this webinar was say, okay, people have thrown us some change. One of them is an official change from COSO. Two is the PCAOB is kind of saying that it's, I don't know if it's raising the bar or we're having to meet the raised bar or however that's working. We'll discuss that with Sonia. And so now companies are kind of caught in the middle. Their auditors are saying things. The PCAOB is saying things. The Treadway Commission is saying stuff. And we think that if we're proactive about this, maybe we can get some positive benefit from it. Maybe we can kill two birds with the same stone and do that. So this webinar isn't going to focus as much on the nuts and bolts than it is on the interactions and the ways that we can take this and try and make things better and understand the interplay between two of these changes so as to make adapting to them more efficient. So what I'm going to do is I'm going to go ahead and move down to the next slide. And here's a little perspective look. So the regulators are sitting on the top, and it's the SEC and then the PCAOB are sitting on the top, and beneath there, there's the COSO Treadway Commission and the audit firms. All of those people are interested in how effective are our controls, how monitor are our processes, and how efficient is our test. The controls, not only is our structure effective, but how well do we do the controls? The processes, how well do we monitor the actual compliance, and how well do we monitor changes in the environment, and then a test. How well do we do the internal audit, and how well do we do the external audit? And all of this is coming down to the company, where the company's having to take these changes coming here, align them up, and make them more visible to the ultimate regulator, which in this case is the SEC and the PCAOB. Sonia, you've been dealing with this for a long time. You've been seeing people. You were there when people adopted SOX for the first time. That was a fun experience. You've been there as they've kind of been dealing with the ever-changing interpretations and that stuff. How's this new change feeling? Is this a minor change, or is this something that people need to really be paying attention to?
So there's two changes, as you stated earlier. So the first change is coming from the regulators of external auditors, and that's the PCAOB. They set a more rigid bar. It's a higher bar of how to audit internal controls, which we'll cover in a minute. And then COSO is kind of the support system. They are probably one of the top 4 global leaders in terms of defining what controls are meant to do, what are the core objectives. And so they are, quote-unquote, refreshing their framework. It took over 20 years for them to do it. And we'll cover in a case study later on in the program exactly, well, what does that mean? So people are seeing opportunities in terms of, well, I have to revisit this updated framework. The question now becomes, do I do a mapping exercise just to pass and get my audit committee off my back saying, yes, we have adopted it, or do I do a better job in terms of trying to find opportunities, whether opportunities relate to effectiveness and efficiency of operating their SOX program, or even, dare I say, try to find a better way of creating revenue sources. Some people see it as just a regulatory requirement. I just got to do it. I check the box, do a mapping, get the auditors off my back, get the PCAOB happy when if they select the company. So I'm kind of seeing a mixed bag, but I think that the leaders, the thought leaders in certain industries like healthcare that are already heavily regulated, banking, they're seeing this more of an opportunity to make their programs more efficient. So it's kind of a mixed bag.
So in terms of the company's responsibility, the company's responsibility is to make sure that the new COSO framework is implemented. We have to get that adopted, and to make sure that the PCAOB's issues are dealt with. And that's from the company's point of view, and they have some direct responsibility. The secondary issue is that the PCAOB can't see this unless they're looking through also the external auditor's work papers. And so if you look at the internal responsibility, is how do we get the external auditors to really see what we've done in an efficient manner, document it well, so that then the PCAOB or the secondary auditors and the SEC by extension can see what the PCAOB is doing, the PCAOB can see what the external auditors are doing, and the external auditors can see what we're doing, and the PCAOB can see sort of the interplay between the company and the external auditors. So, Sonia, if that's not done right, I mean, I realize that the company has a certain responsibility, and the auditors have a responsibility, and the PCAOB has a certain responsibility, but my always thing with responsibility is if it's not done right, who ends up paying? Who ends up bearing the brunt if this isn't done right?
The company overall. The number one question that we have found when we talk to, let's say, prospective clients or even at conferences is when people answered, I don't know, the number one question that I get the answer, I don't know, is external auditor reliance. I ask, what's the percentage that your external auditors are relying upon the company's top quality good stuff, right? The good stuff for internal controls. And I get the most common answer, which is, I don't know. They have no idea what percentage. And there's a link to good audit standards that the external auditors can and should use. But again, it's having that dialogue and creating a partnership. So to quickly answer that question, it's the company that overall pays because the auditors are not having dialogue with their clients to create that good partnership and communication as to what they can and should rely on.
And what we've heard this year is that if the PCAOB is not in line with what the auditors are doing, I keep hearing from more and more of my clients, we've had to do so much extra work because the auditors have come in and said the PCAOB could, would, maybe will ask for all this stuff, so we want to see extra documentation here and extra documentation here and more there and here, there, and the other. And all of a sudden the companies are going, wait a minute, this is taking us a lot more time and effort, and the auditors are telling us a lot more needs to be done. And so if the company wants to take care of making this more efficient and effective, I think the company's going to have to look back a little higher up, even though I know I'm going to hear from everybody that's not our responsibility. You're the one paying for it. You're going to have to understand what the PCAOB is saying, what the auditors are supposed to be doing and what they are doing, and how what you're doing sort of shines through that so that there's not this additional work. Then the next thing is obviously this represents a change. And so we hear from people all the time, well, you know, there's one change and another change, and we're very busy in this. And Sonia, do you think this is the last time we're going to see a change from the PCAOB and this is the final shift? Or given your experience and everything you've seen, are we going to keep seeing the bar move?
We're going to see the bar move. Last year, one of the board members of the PCAOB stated that they are working on what's called an audit quality model. So imagine a COSO framework-like product, okay, issued by the PCAOB on what is an audit quality model, or they may call it a framework, I don't know yet. So the bar is going to move, and it's going to move higher. And we're just waiting, probably next year, a draft might be issued about what that model would look like.
So I want everybody to understand that the evaluation model is moving, the model behind the internal controls, the COSO stuff is evolving and improving, and as you say, being refined after over 10 years. And then what's happening at the companies? Because we did a very interesting poll when we did a panel with the SEC professionals group. We did a very interesting poll asking people how many significant changes or how many significant items affect their accounting department. So I'm not looking, we're coming up to a polling question here. And the next polling question is going to be, what changes affecting your sort of financial reporting and close have had a significant impact on your financial reporting in the last 24 months? Now, because of Go-To, we're only allowed 5 answers. So we've merged things together here, merger and acquisition and disposal of a business, reorganization, new divisions, products, staffing availability, this is reassignment, absence, turnover, ERP upgrade, changing in financial system. Which ones of these have you seen in the last 24 months at your company? And other can cover new CFO, other can cover anything else that is a significant change that would have caused an impact on your financial reporting. Please check all that apply and tell us how many different things in these categories have had a significant effect on your accounting and finance department within the last 24 months. Because what we're trying to show and what we're trying to deal with is how much change are we dealing with. We've got frameworks that are evolving. We've got bars that are being raised. We've got an underlying changing environment. How many things are we having to deal? And should we be dealing with these things on a one-off basis, or should we be dealing with these things on a continual basis? So I'm going to go ahead and leave the poll open. Again, there is no right and wrong answer. What we're trying to do is get you to be able to, these are for CPE credits, although we'd like everybody to answer it, because what we like to do is look at the information and see what we see. So when we did this before, we got some pretty interesting responses. We're covering over the last 2-year period. We normally leave the polls open not for too long, so please hurry up and get your answers in. And then, again, you check all that have applied, and we're going to go ahead. And normally we close the polls right about now. So what's interesting to see in this is, for those of you who have a long history in accounting, what's interesting to see is how when you look at the results here and show the results, you see that it totals up way more than 100, right? So if I do my quick math, although we know how accountants do quick math, at 60, 100, 150, 160, maybe somewhere between 160 and 170%. So which means we have more than one change per company, even in a 24-month period. We're actually coming to the fact that there's usually almost 2 changes per 24-month period, or about 1 every 9 months, that is occurring at companies based on our experience. So we're going to go ahead, and Sonia's going to take over here, and Sonia, you're going to get us started with what exactly did the PCAOB say. So we have the change in COSO that everybody's aware of, but there was a change in the PCAOB which maybe people weren't as aware of. Sonia, can you carry us through where this came from, how it's going to affect people, and why we care in light of the COSO issue?
Right. So, yeah, thanks, Gabe, for passing the ball over. I'm wanting to cover something of a why factor. Here you see the PCAOB's Staff Audit Practice Alert 11. The why factor that I like to tell folks is, well, why would the PCAOB even issue something like this? And more importantly, why was it done very late last year? So the why factor is back in 2012, this was done in December. So a lot of the Big Four and other accounting firms that are registered with the PCAOB received a nice little Christmas bonus. And it was a root cause analysis of what were the common audit failures of the top 8 firms, and they looked back at, essentially they were looking back at 2 years of history of audit failures of the top 8 firms. And when they did that analysis, they issued a report saying, well, this is the root cause of what happened. So the common audit failures that they cited that were also summarized in this audit alert were, one, the accountants just, unfortunately, they just dropped the ball. They didn't identify the right controls, the sufficiency of controls for those related risks that they need to mitigate against. The other was testing the design and operational effectiveness of management review controls, which we are going to get knee-deep in later on in this presentation. The other is how much evidence. Was it good enough evidence? Was it the right level of evidence? Was the testing around that good enough? Were the roll-forward procedures good enough? And another summarized issue was system-generated data. This goes to both what the company produces and what any outside service provider provides for you that you leverage in certain key controls. Maybe we can, okay. So, excuse me, let me get back to my, show my screen here. So I wanted to cover an item of typical closing of the book. So this is an example of what, this is a firm. I've hidden the name of the firm, but this could be any external audit firm. So what I've highlighted is a Part 2 report of what the PCAOB is trying to find in terms of an upgrade, if you will, in your audit procedures when you look at closing your books. In this case, the audit firm, they picked up an issuer, and they were looking at journal entry testing. The firm did pick a sample. There's nothing to say that the sample was bad in terms of what types of journal entries they were looking. It was the procedure of evaluating those journal entries. And the procedure, the testing procedures that the auditors conducted was basically taking that journal entry, that top copy, looking at the signature, and then tying that out to supporting documentation. And then what they lacked was this new definition in the audit profession that a lot of people have not been aware of, and it's called the level of precision. So that, we're going to state that phrase, level of precision, throughout this program. And the reason why I state that is because the level of precision is going to fluctuate, it's going to bend, it's going to move depending on the type of control. So in this case, they were looking at the journal entries, but they didn't understand the level of precisiveness that management did per journal entry, right? Because not every single journal entry is equal. And they didn't understand the level of control items that management goes through per journal entry to prevent or detect a material misstatement. That was their flaw. It wasn't that things didn't tie out. The numbers were fine. There was no incorrect number there. It was just identifying the right types of controls per journal entry in terms of the level of precision. So wanted to move on to another example, which is dealing with a period end close issue. So in this case, it was a different issuer that the firm conducted a period end review. They were testing the period close. They were looking at certain tests of controls, but unfortunately, they only limited their review of the control based on signatures, right? So they went to a certain checklist. They looked at monthly reconciliations and reporting packages, and that was fine. They also noted that, hey, the reviewer of that month-end close package had a couple of notations, and they noted that. The firm, reviewed it. But the problem, again, here was the firm just didn't get enough detail to make sure that their, meaning the external auditor firm's conclusion was, hey, this type of review control was at a level of precision to prevent or detect a material misstatement. So I wanted to give you guys a snapshot of what is, let me go back here, the plain English version of what the heck is level of precision. I mean, what does the PCAOB really, really want? Okay, they use it in a firm's analysis in their Part 2 report. They ding them. What does that mean to you as a company? So the first thing is they want more detail. They want more meat. But what does that mean? They want to document your thought process. And sometimes your thought process might include, for example, a dollar threshold. For example, AR allowance. Are you looking at certain AR aging buckets, and are you looking at certain dollar thresholds within those AR aging buckets? Are you looking at a percentage of some type of profit and loss statement line item like revenue, or it could be a balance sheet item? Are you looking at geographical location impact? For example, certain locations might be more relevant to you in your thought process when you're looking at a certain type of review control versus other locations. Also, different lines of business, especially for those of you who have a mixed bag of revenue sources. Some journal entries you're going to review more thoroughly, like, for example, if you sell software versus, let's say, you have a mixed bag of widgets or hard goods that you're selling. The revenue recognition process might be a little different, and therefore, certain lines of business you're going to scrutinize more than others. And then other risk factors, and what they're stating here is internal risk factors and external risk factors that impact your review process. Some of it could be politically driven, some of it could be regulatory driven, et cetera, and then the timing. So this is a layman's, I would call it a quick hit list of issues of how to document your level of precision when you're documenting your SOX 404 controls for the external auditors. Now,
Sonia?
Gabe?
Yes. So we're not really saying that people weren't necessarily doing the thought. We're just saying that the thought is not being captured in the documentation. Correct me there if I'm wrong, but the issue here many times is not that it's not being done, but that an auditor's coming in and maybe they're having a discussion of what the thought process was, but when the PCAOB is looking at it, they can't seem to tell what was documented, what wasn't, when they did one, when they did another, and what types of things these controls, because we're talking about controls testing, would therefore be expected to catch. Is that a fair other layman's presentation to that, if you want?
Absolutely, Gabe. And one of the common restrictions that I hear from management, they are telling me in the field, like, okay, you want me to document my thought process. And what I tell them is, look, take credit where credit is due. I know you do this. I know you look at certain dollar thresholds. I know you look at certain percentages. It's just putting it in that text. The common, dare I say, pushback or common compliance challenge, that's another way of saying they don't want to be put in a box, you follow, because business models are in flux sometimes, or they're growing or decreasing, or let's say they're changing, mixing things up. They don't want to be pigeonholed to a box if they need to change. They need to flex their muscles, so to speak, their control muscles. And what I tell them is there are very unique and precise business writing skills that allow you to flex your control muscles. So what we do is we craft the language that gets both the external auditors happy, PCAOB regulators happy, but allows that control muscle flexibility to our clients, because let's face it, there are going to be times where you're not going to be looking at, let's say, the exact same percentage or the exact same dollar threshold quarter to quarter, month to month. So it's kind of I call it, it's more of an art form of business writing rather than just a boilerplate copy and paste.
Right, and I think they've spoken against boilerplate. So we should move forward, but the answer to this is not boilerplate. I think that's part of the. I think that's part of where they also get concerned is when we've got the same exact explanation for 20 different analysis, and they go, we know you're doing different things, and you're not explaining it. So you're going to show us sort of the old and the new, the previous and the recommended. So I'll let you continue.
Great. Yeah, thank you. So this slide actually came from a presentation I did in Washington, D.C., and I just so happen to have 3 PCAOB managers there. And the short of it is I shared this slide to say, look, I did the speaking engagement in November. We had digested the October audit alert, and I wanted to come up with like a case study. So this is the older language that we, meaning our clients, ourselves, the external auditors, relied upon, which is assigning and date of a control. So in this case, the older language was dealing with a quarterly control that the controller was reviewing the AR allowance, and they signed and dated a reserve analysis, right? So from our perspective, we would look, tie out some dollar totals. We would look at the journal entry, and then we would look at the signature and some of the supporting documents. It was very, very easy, cut and dry. Today, right, and I just put this as an example to this other class that I was teaching. I said, here's kind of, right, this isn't exactly, but this is kind of the massaged version of this level of precision that we were talking about earlier. So in this case, taking that older language of the sign-off by the controller, I'm looking at it now and saying, well, wait a minute. This controller is looking for significant customers that have outstanding balances greater than, and I just put out a dollar threshold, 100K and 5%, and you'll see I go on to talking about those that are under that threshold that exceed 90 days. Well, if they're not within that dollar range, but they are over 90 days, then the controller really is looking at the type of customer, what they're buying, et cetera, and then they're looking for adjustments if needed. And so if there is an adjustment, this controller is a team player. They're working with, let's say, the AR manager and maybe, who knows, other people, but you'll see that I put there in highlights that if an adjustment is made, there's a communication to team members that help him get to his conclusion to book that adjustment. The quick story about the background of the old versus new in that class that I taught last year in November was there was a CFO of a public company, and she raised her hand and she says, you know, Sonia, this isn't fair because the older language worked. We were fine. And now you're asking me to go back and write all this stuff in red and beef it up. And so I said, you know, this is kind of the prudent official test of this was really the way we should have done it. There was a guy in the middle from the 3 different PCAOB folks that attended that class, and he raised his hand and he says, look, I want to address the CFO's comment. And I gave him, time, and he said, look, ma'am, I'm sorry that you feel this way, but, I just joined the PCAOB, and he was explaining that if you go back to the old auditing textbook, this was actually the true standard. And in a nutshell, he wasn't quite apologizing for what the PCAOB got away with, earlier, but he was just saying, look, it's what I had written down is really the bar that should have been in play when everybody was implementing SOX 404. So, this is really the tried and true statement that we need to be writing now.
And Sonia, I would say that in having had conversations directly myself with the PCAOB and others, and being at conferences, this next conference that I'm going to be at is going to have Jay Hansen there from the PCAOB. I think that's been the PCAOB's line for a while now. The standards are there, and we're just enforcing to the standards. Maybe it wasn't enforced as hard before, but we're not changing the bar. We're just asking people to get closer to it. So whether you agree with that or not, the realities here, the reality is that it's not a change of what of the rule. It's at best an interpretation, if not a clarification. So I think we have this. I think we're going to see it keep going in this direction. I think as the PCAOB, and I feel bad for some of the firms when you read their inspection reports. It seems like the percentage of failures and that stuff is staying the same. I think that might be the case, but I do agree that the firms have cleaned up some things, but now they're being tagged on other things. Whether it should have been worse in the beginning, who knows? But at this point, the direction of the bar seems pretty clear. It does seem to be getting closer to what was originally stated, and so point taken. It feels like a change, but some would argue it is, some would argue it isn't. But as we all know, it's kind of reality. So where are we going now?
So where are we going now? Now it's just more robust documentation to provide both internal auditors as well as external auditors and regulators that nice audit trail. So I wanted to share kind of a thought process in Excel, Microsoft Excel, something very, very common to a lot of financial folks. with us today on the program. So first, it's documenting in Excel. Okay, well, if you are using a dollar threshold or percentage, you need to tell the reader, okay, well, okay, what is it? You know, how do you know it was really sufficient, right? Did you get buy-in from other folks? You know, given that most controls take a team effort to make an adjustment. Did you take any other considerations, and were they very key in your decision-making process? And then we're going to cover very briefly how to document management's review. I'm going to give you a before and after, and the after is just kind of a very plain vanilla after of what I'm seeing in Excel. And then remember, every reviewer is different, so the depth of review from a manager versus the controller, their point of focus is going to be different. So that you also need to take into consideration in terms of that level of precision that the PCAOB wants to see documented. Here's the example. Imagine you have an AR aging report, and here you have a series of different customers, and I just created some certain names here. So we've got a loyal customer, new customer from Russia, trying things out customer, so they're just testing the waters, and then a not-so-new customer, right? And in the AR aging report, this is related to an analysis of AR reserves. We're looking at the last payment amount and the dates and the amounts that they paid, and then we're looking at the AR aging buckets. Now, the allowance analysis is right below, and it shows, well, new customer Russia. Now, there could be some external factors, as we all know that there's certain things going on in that part of the world. And it looks like, as we're looking at this dollar amount, the entire amount is written off, right? They're saying, you know what, we're throwing in the towel, let's write off Russia. This trying things out customer, it's a percentage of the total balance. So it's not a particular bucket, but just a percentage of the total. So now we're looking at the current GL balance of what the reserve is. The company has $500K booked right now, and the delta, the difference is they need to book an additional allowance of $302. The old school of auditing, right, so pre-Audit Alert 11 is we would just accept the signature, tie out a few GL items and look at the journal entry, et cetera, and then maybe document the interviews with the controller and the AR manager. Now, the after, in terms of what the PCAOB and other external auditors want to see, again, this is just a plain vanilla kind of example, is document your thought process for Russia. So here you see on the box, there's a text box here that says Russia allowance supporting documents, right? So this was intended to really hone in on, we completely wrote off Russia, okay? What's the why factor? Well, we looked at various reports, one of which was some AR client detail report. There was an invoice, a payment history. We had some emails going with different folks within the organization. And then we even saved a confirming email by the COO and CEO specifying Russia to write that off. Okay? So this is giving you, again, a plain vanilla example of the total write-off for Russia. You would have to do something similar to your trying things out customer. And I've highlighted a tick mark because auditors and we're included in that bucket. We love tick marks, so you'll see tick mark A. I'm highlighting for you, the participants of this program, to understand that this is part of this concept that the PCAOB has put out there, which is called system-generated reports, which we're going to cover a little bit also in the program. And this ties into page 27 of that audit alert of what you need to do with those those system-generated reports. So this is kind of my way of sharing best practices that typically what we see in Excel is that we would see these A's, but then we'd say, oh, by the way, reader of this document, please go to our inventory sheet of key reports, management reports, because ultimately we have to test them. So as you can see, this is a very vanilla after example. What we're seeing is sometimes embedded documents in Excel that tie out, let's say, a PDF version of the email. We're seeing hyperlinks to, let's say, a shared drive. So the gist of my comment of this after example is that we're looking at very, very complex Excel documents that tie to management's thought process.
Sonia? So we had a couple questions which I want to not go too far before they come through. Somebody came through and said, geez, it sounds like a level of precision is based on factors that can be very subjective. How will we get consistency throughout the industry? I think part of the answer is in a lot of these areas, they are subjective. And I think this is why this becomes more difficult for people to address, is because these factors, many of the subjectivities are very unique to your company, unique to your industry, unique to your customer situation and the way you address them. So I don't think that there's going to be a canned way of doing this. I do think that there's always going to be a very good level of subjectivity, which I believe all of the CFOs and controllers and et cetera want. And they're not saying you need to have a standard way of doing this. They're saying that you need to have a way of showing what you are doing. They want to see your subjectivity because that's frankly how you're coming to your discussions. There's another question, can the level of precision be confirmed during a walkthrough in order to rely on signature review for effectiveness? I'm going to let Sonia handle that one. I'm going to say that during walkthroughs, I think you do get a certain amount of information, and where exactly the documentation lives is somewhat interesting. But during walkthroughs, most of the times you're dealing with what do we do in the normal situation. The next question is, if a unique situation comes up, like Sonia talked about, maybe it is, some Russian receivable having to do with what's going on now, your subjectivity may be much more specific to that instance. So Sonia, do you recommend that people have a better handle and give a better view on their level of precision in the walkthrough and in the standard documentation?
We're seeing currently, yes, the walkthrough is documenting that level of precision. And if we go back to our old auditing textbooks, the walkthrough, the purpose of a walkthrough was just to give the auditor the understanding of how something went through point A to Z. Okay? It does not actually support your audit opinion because it could or could not be part of your sample size, but it was supposed to be a standard, right, a bar set for auditors to say, well, how do you know revenue works this way? You should, before you test it and you pick all the samples you need, before, walk through it. So yes, we're seeing a lot of more in-depth walkthrough documents and language being done to show that management has that real deep level of precision.
I think, Caroline, you're going to be up next flipping the 3 slides that we had added. One of the things I wanted to show people is that there is a way, and there are ways that people are using rather sophisticated ways of doing some of this stuff. This is just a sample, so you can do this with any type of technology. But in this example, here's where they're documenting their procedures, their desktop procedures, their review procedures, their workflow responsibilities. They're documenting things and handling their documents, the preparer notes, the reviewer comments. You can get a lot of this on one screen depending on which technologies. And I know that there's a varying amount of technology, so I'm not here to push any one technology. I know that there's things that companies like Blackline and Trintech and, and SAP, who I did a webinar for recently, everybody's got a certain amount of answers. But there are ways of being able to see your prior period documentations, having electronic signatures and due dates, addressing your file shares. All of these different things are available to people to have technology help you leverage. Now, this is actually where somebody's doing their procedure, their allowance for doubtful accounts work paper. This should be, in better situations, linked towards where they do their compliance work. So if you go through here, it can be linked to where you're doing your compliance work. So having the electronic links in between, where is it that I'm validating and verifying what I'm doing, that is a very good thing when you're dealing with controls and external auditors and that stuff. And when you're dealing with external auditors, you need to give them that vision of being able to see it. So if you can publish all this stuff out and put it in a format where the external auditors can see the hyperlinks, the documents, all the stuff that's together in one convenient set, it's very helpful. You can do this with a bunch of different technologies, but technology can very much help. I think that everyone out there who would who would say people who are doing a lot of this stuff, managing checklists through Excel and burying things into Excel and doing things like that. I love Excel for certain purposes, but it's also not appropriate for other purposes. So there are things that can help you. We'll keep moving on here and come back to what's the next slide, Caroline? So, key report testing. Now, I'm going to ask Sonia to gloss a little bit over key report testing. Remember, what we were trying to do here is show the level of documentation and precision. But in talking about COSO, we now have a change coming our way. And somebody else put in a question, what documentation? Are we just doing extra documentation, the CYA, yada, yada, yada? You know what? The standard is supposed to be have the documentation that is useful so that if another person came in to do the work, could they reperform it and understand it? All right. So is documentation there to make the auditors happy? When you're doing documentation for documentation purposes and for auditors, you know, maybe you are over-documenting or maybe you're not doing it in a way that makes sense. I would tell you that if you have your documentation so that a person can come in and reperform and understand the decisions that were made, that's beneficial to you and it's beneficial to what you're doing. So as we move closer to the COSO stuff, Sonia, you can go over the report testing, but I would do it a little lighter so that we can get to the COSO stuff and people can understand that as you go doing your changes to COSO, keep in mind the new levels of documentation so you don't end up doing it twice, so you don't end up having the auditors come in and say, well, we can't understand what you did or how you mapped or how you covered. So the first part of this was to show you documentation needs to be made more transparent and you need to be able to see things that are happening. And then the second part of this is, okay, as we explain the COSO changes, how do we do that with the documentation? So I'm going to let you keep going, Sonia.
Okay, great. So this is part of the Alert 11, and what it comes down to is trying to tell readers that we need more evidence about the review process. And in this case, they were saying, look, verifying a sign-off is not good enough. So if we can go to the next slide, Caroline, that'd be great. And in terms of IT-dependent controls, this is from page 27 of the PCAOB alert. The gist of this part of the alert is to tell readers, especially the external auditors, that any system-generated report, they want to know that you've done some control testing, right? Those lovely IT general controls like security, completeness checks, accuracy checks, change management checks, etc. So going back to that tick mark A of those key reports, you have to have an inventory sheet of that, plus show auditors that you've done an accuracy, completeness, those lovely IT general controls on those key reports. If we can go to the next slide, Caroline, that would be great.
We're at our next polling question. This is the second polling question that we've had, and I'm launching it right now.
Thank you. So this is a polling question to share with you another audit concept that's in the alert, and it deals with multi-location. So we wanted to find out from the audience here, you know, if you had to compare last year, what is your multi-location situation? In other words, do you see the locations in terms of increasing in the complexity or minimally increasing the complexity, or you don't really see a change in any of the complexities within your multi-locations? Or for those of you who do not have multi-location issues, then you can just check the box there and say you have none.
So again, the point here is not right or wrong answers. The point here is just simply to register. And so are you seeing, you know, your multi-location issues increasing in complexity? You know, no big increase, little increase, no increase. I don't deal with multi-locations. So again, just trying to get an understanding and give an understanding to everybody who's got multi-locations, whether or not this is an issue. We do see that because they're getting more detailed and more granular, the multi-locations and the deviations between them tend to cause more difference. So we're going to give about 10 or 15 more seconds. I really need people to vote in You know, I know some people aren't taking the CPE, but if you go ahead and vote anyways, then it gets us to the completion ratio. We normally try and get up about 90% before we cut it off to make sure we haven't left anybody off. So if as a courtesy, even if you're not going for the CPE credit, if you could just click the button, then that'll get us there. So we're going to go ahead and close this down and show it. 39% increased significantly the complexity. 24% minimal increase, 19% no change in complexity, and 19% don't have anything to do with multi-locations. The interesting part here, and you know, just think about this as you go through, are some of you who don't think that the complexity is being increased missing something, or are some of you that are seeing increased complexity, over-complexifying things, and et cetera. So this is just an area where we think that there's a little less guidance, if you want. It's been put in as a hot button, and we do think that a thinking approach to this, and again, I'm not from the school that says we should be, you know, overkilling. As a matter of fact, I think overkilling is worse because then you start going in the other direction. The more overkilling you do, the more chance you mess things up and whatever. So I'm a fond believer, for those who have followed me on the Tuesdays with Tony that we do with Tony and et cetera, I'm a fond believer in doing the work that's necessary at the time that's required in a prudent manner. I'm not one of those that says the sky is falling in, let's document the daylights out of everything, because then all that documentation just gets old and all sorts of other stuff. So this is an issue that I think that if you're on either side of that spectrum, you want to take a look at. One of the things that I know Sonia's group does is they come in and they do evaluations of your approach. They do evaluations of what you're doing and of your mapping. I think Sonia's group can help you understand some of these issues. You may or may not even agree with the line she takes, but you'll definitely understand the issue. You'll get a visibility into what other people are doing, and then you can go ahead and make your own decision. So, Sonia, let's keep going from here.
Okay, great. So I don't know, can you guys see my screen here? Clean. Okay, great. So here I've taken a filer. This is an issuer and an external auditor. So the PCAOB issued a Part 2 report dealing with multi-location issues. In this case, I wanted to hone in on a concept of homogeneous controls by location. So some auditors believe that, hey, if the business units are really aligned to corporate office, most of the controls like bank recs and controls around AR reserves, et cetera, are pretty much homogeneous because, you know what, corporate office set the policy. In this one example where the PCAOB found a mistake on multi-locations, they found that, look, the external auditors did a walkthrough on controls and they thought everything was working just as planned, that the controls were pretty much homogeneous on all the locations. However, when they did really deep testing, they found some exceptions, and so did the company, right? The company had its own internal auditors. But what they found is those exceptions of controls were different, right? So the depth of the issues were different. So the notion that everything was being done uniformly was actually incorrect, right? So what the PCAOB really honed in on was you guys did less. You guys not only did the internal audit department do less, thinking that all the controls were the same everywhere, and they actually scoped out certain locations, but they were actually incorrect in assuming that because the root cause of those failures were actually different at each of the different locations. And therefore, the conclusion when it came to testing controls, they didn't test enough. It was insufficient in this one case. So the PCAOB, what does it say about closing the books in the audit alert? So in the background, they give you, in page 15 of that alert, how to do a better integrated audit approach for multi-locations. And the key question of what the PCAOB wants to see is, if you're going to say there's consistency in closing the books, please prove it to us. That's what they really want to get to. They want to look at that management review controls at corporate office are also working, because ultimately there's this one big reporting unit that issues reports to the SEC.
And Sonia, I know you've got a way of getting this to, if you go a little further, to the COSO, and I think we go to 27 to the COSO tie-in. So inside of COSO, one of the things that they're looking for is this whole multi-location aspects, because it's not just necessarily looking at controls at one entity as it is if you have multi-locations. You're going to have to go do some of the COSO assessments at the entity level, and again, with the documentation understanding that the PCAOB, one of their hot buttons is this whole multi-entity, and are we going deeper than just making one company-wide statement. So as we go through, we're going to link this into the COSO. I'm now predicting that we're probably going to go about 10 minutes over. So letting people know that we'll probably be about 10 or 15 minutes over. Sonia's going to hit the COSO high points here, and then we're going to go to that. It's obvious to me, and I apologize, that we have a lot of really good material, and we're going to go ahead and schedule a second continuation to this to go into a little bit more detail and some other stuff. But I think it's been very good. I'm going to let Sonia hit the COSO stuff. We're going to go a little bit over, and then go from there. Keep going, Sonia.
Great. So I wanted to provide us as a team, okay, an example of what COSO in its guidance, okay, this is the latest guidance that they issued, and this is coming from Volume 3. I wanted to share with you control activities is a component, that's your checks and balances, and your risk assessment component. This is a process of dealing, well, how do I know when I transition to the new COSO framework, when I'm testing controls, especially period and close, how do I know I'm meeting the mark when it comes to the new framework? Here's a quick case study. This comes from Volume 3, page 110 to 111. The background is it's a public financial services company. They have 3 divisions, A, B, and C. And the objective of the internal controls is external financial reporting. Some of us just call it SOX 404. So what's the overview of the assessment of controls of this particular company? So what they found was that management determined that it had some revenue recognition issues, okay, in a particular area, and it was coming up with Division C was up and coming. In other words, some of us would love to have a division that their revenue growth is just going great, it's increasing in terms of adding value to the entire organization, but what was happening is the errors around Division C weren't really known to the company. So they did a root cause analysis, and the conclusion was that, you know what, management failed to implement key controls, right, control activities, over their RevRec process in Division C. So let's say 1 year, in this particular case study, 1 year it was actually insignificant. This year it became significant, but guess what? They failed to catch it, and they failed to implement key controls around Division C. So now, that's management's assessment of this particular division. Now we have a quick polling question about, well, how bad, and I don't know, Caroline, if you can take over, how bad is this scenario? You know, do you think that this scenario is just a control deficiency, significant deficiency, material weakness, or it's not a deficiency at all when they found out that when they did their root cause analysis on Division C?
We're having a problem with the polling question, so
okay.
Keep going. We have another polling question we can use as a substitute.
Okay, no worries. So whenever I present that particular case study, most people feel that there's just a control deficiency, meaning it's A. The real answer, and again, this is straight from COSO's own guidance, is that it was a material weakness. But guess what? It wasn't just a material weakness on the control activities piece, which is Principle 10 in the new framework. There's only 17 principles. But they found another material weakness in the updated framework, Principle 9, which is dealing with identifying and analyzing significant change. So this, whenever I present this particular case today, I get an aha moment, because some people would agree there's an issue. There is an issue in control activities, but they didn't link it to the risk assessment component of the COSO framework. Caroline, is this the polling question that you wanted to put in about third parties?
Yeah, so I've launched this.
So I wanted to make sure we got a polling question to be able to grant the CPE credits. This polling question is, how many of you have consulted with a third party on your COSO framework mapping, the implementation, and that stuff? And so just wanted to get a feeling, because we weren't sure what people were doing. Have you done a detailed review with a third party? Have you done just a review of high level and sort of the implementation stuff and where sort of the risk assessment level? Have you not done any but plan to? So are you planning to use a third party? Have you used a third party at the high level? Have you used a third party at the detail level? Or, hey, we're not going to use any third parties, we're going to do this all internally. And so just trying to get an understanding from companies where they're at in the use of third parties here, more from a not really understanding what companies are doing perspective. Also, I would think that as we look at this data, I would think that larger companies with larger departments would go in different directions. But it's always interesting to look at the data. As everybody knows, we tend to put these questions in usually in subsequent webinars. I will break apart the data and many times use it to show some insights and those types of things. Alrighty, so again, I don't want to let this run too long. I would appreciate if everybody would just give a vote. Some people may not know. You can just put in don't plan to have any. We probably should have put a fifth one, do not know, because some may not have done this stuff. But anyways, so as we're going through, we're going to go ahead and finish this again. If you could just answer the poll, that will get us to closing the poll, and I think we're going to go ahead and close it. All right, so 48% don't plan to use any third parties. Frankly, I think for a lot of people who had it well mapped before and et cetera, I understand the approach, and that's I don't think it's one where you necessarily have to. 19% haven't but plan to. 20% have reviewed the high level. Again, I sometimes like to involve third parties just to see if I'm headed in the right direction and know what I know and know what I don't know. And then 6% have done a detailed review. So again, an interesting survey result, a good scattering of the answers and we don't all go the same way, and many times we have good reasons not to. So let's go back to the slide, and where were we on what COSO had to say? So COSO had said that those were material weaknesses, and again, remembering from that earlier one, when COSO says that it's a material weakness, there are examples that are in the COSO guide, and I think Sonia can tell us just here about the COSO guide. There are good examples in the COSO guide, like where she drew that one, where they give you very good, clear indications of where they think and how, which are the 17 key criteria that they're calling out, some of the points of focus, and also whether there's issues. Sonia, just for 2 seconds on the COSO guide, a little thought on that. I know you've been through the whole set of guides, so there's 3 of them. Just a quick thought on that.
Great. Yeah, thanks, Gabe. So there are 3 source materials that I would highly recommend, 2 of which are free. One deals with, on the far left, COSO's improving organizational performance and governance. So this is kind of taking that value add concept. The items in the middle is called a bundled package of the new guidance. You have to purchase that on cpa2biz.com, which is the AICPA e-commerce site. And the one on the right is also a free download. It's a PDF that COSO put out with guidance on how to transition to the new framework, especially if you need to become SOX compliant. Now, for those of you who like quick hit lists, checklists, etc., our blog has a download of a template that we've created that takes apart those different volumes, especially volume 3 and 4, which I call the meat and potatoes of how to transition. You're more than happy to download it for free if you'd like. There's a template of how to do it. We have some YouTube videos of how to use our template as well. And the last I wanted to get through is the next step. So let's say you need to transition this year. Most of the clients that we're dealing with are asking us to first off, identify a steering committee. So there's an initial intake process that needs to happen, and sometimes it's a collective group. And then you need to do some type of analysis and benchmarking and then come up with some type of result document for the audit committee and executive management. Now, our particular process that Gabe was alluding to earlier is, we call it the control compliance analysis. So for those of you who are here today, we've carved out 3 spots to get a control compliance analysis with me personally. And what it covers is some of the top transition failures I'm seeing that are based on case studies or it's based on my own experience, et cetera. Audit evidence that's required for the new COSO transition, transitioning to the new framework. We've aligned it with other regulator standards as well as professional standards. It's approximately about an hour intake process.